Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. If you'd like to know the absolute latest on any commercial real estate related topics, check out our on-demand show podcast. For example, last week we covered the multifamily market, and the week before we looked at retail and retail real estate. There are lots of interesting shows to choose from. So grab your phone, tablet, or computer and visit the show website, commercialrealestateshow.com. Well, today we're talking about the U.S. industrial market. Please welcome my next guest. Join us by Skype, Mitch Roschelle, partner and U.S. real estate advisory practice leader with PwC. Mitch, welcome back to the Commercial Real Estate Show.
Thanks, Mike. And I'm thrilled to be the first ever Skyped-in guest.
That's right, the first Skyped-in guest on the show. We're glad to have you. Well, Mitch, what do you see as far as the industrial fundamentals? How are they trending?
Well, if you sort of need a little bit of a historical perspective, let's go back to the year 2000. We added supply in 2000. We added supply in 2001, but then the additions to supply sort of fell off with the financial crisis that hit. And industrial, being the least sexy of all of the real estate sub-asset classes, isn't going to get a lot of lender love. So there wasn't a lot of construction lending for industrial. And it wasn't until really the past year where we added 233 million square feet of industrial space that we really saw some additions to supply. But there's still a big gap between absorption and additions to supply, which I think really is the underpinning of the strong fundamentals for the sector.
Okay, so you're seeing strong fundamentals on rates and occupancy. What about rate growth? What do you see there?
Well, rent growth similarly really is kind of a great story. Forgive my paper shuffling here, where because of that supply and demand imbalance, we're seeing rent growth that is really a good story. 2013, we saw rents getting to 522, which is the highest level since 2009. And then the rent growth rate is even a better story, which is the highest rent growth rate, since 2006. So it's the fact that we have demand for the space, we haven't added supply, it's being absorbed, and it's driving up rents.
Right. And what do you think is driving these fundamentals, Mitch? Why is industrial doing so well? You mentioned the lack of new construction, but where are these tenants coming from?
Well, you think about what's going on in the box, right? Mm-hmm. So it's all about the retail demand. It's all about the supply chain. And, Ryan Severino's on the show as well. Ryan likes to talk about retail being under demolished. I think we have a little bit of that in industrial as well. We have industrial that's a little old, antiquated, doesn't have the right clearances, doesn't have the right number of bays. So there's some subsector of industrial that's sort of obsolete. Mm-hmm. And then you have retailers that need to get goods to consumers. And in a period of rising fuel prices, you want to get those warehouses closer to where the consumers are.
Yeah, that makes sense. And we're talking with Mitch Roschelle with PwC about the industrial market. And what about investment sales, Mitch? What do you see for average cap rates around the country, and how are they trending?
Cap rates, the interesting thing about cap rates, and I'll draw a distinction between the light industrial and regular industrial. Cap rates continue to compress, and I think the last time I was on your show talking about industrial, which may have been 3 quarters ago, I believe I said that cap rates won't continue to compress. So, okay, I'm a liar. And the reason for that is there's just a strong demand for the asset class, and there's rent growth. So investors are willing to pay a lower yield, but the cap rate sits right now at 6.25 for industrial. That's really the lowest level in history, and it's considerably below the 10-year straight average. But if you look at the light manufacturing, the flex space, cap rates aren't compressing there. And I think that really goes to there's a little bit more risk in flex space in terms of business risk than there is in straight industrial.
Okay. But speaking of forecast, I mean, if you look back at the year before, not this recent emerging trends, but the year before, I think you guys did predict that there would be a lot of demand for industrial investment properties.
Yeah, well, and there's 2 things that came out of this year's emerging trends. Was one, similar to last year, the buy rating for industrial was the highest across all real estate food groups, and 2/3 of our participants saying it was a buy. But this year, industrial was the number one development prospect as well as the number one investment prospect. And from a development perspective, we haven't seen industrial on top in the history of emerging trends. So it really tells you that investors are focusing on something that's relatively quick to build, relatively inexpensive to build, aren't as many barriers to entry as other commercial real estate sub-asset classes, and tremendous demand.
Right, good point. Well, which cities are investors most interested in, Mitch? Where is the velocity and the demand for the investors?
Yeah, they're sort of in buckets. So the number one is Dallas, and I talk a lot about Texas, in the state of Texas, Dallas is the winner. But you got New York. New York's a story of the biggest base of consumers for retail products. That's why there's demand there, because we need to get the warehouses close to where the people are. Phoenix is really a housing story. And then some of the other cities that are hot, Memphis, San Jose, Austin, again, that's sort of the tech story. But if you look at it, it's metropolises where you have a high concentration of people, because there's been a lot of press of late of the online retailers trying to make sure they can get the goods to people quickly.
Okay. And if you're watching this on the radio, you're not going to see these charts, but if you're listening to the podcast, there's a link to these charts below, and of course, if you're on YouTube, you're seeing them. And one of the things that you guys do, Mitch, that I really like to see is not only these charts show where we are today, but that in some cases show a forecast of where we're going. So, what do you expect to see moving forward in the industrial market in 2014 and beyond?
Well, I think what's going to happen is we'll get to a point where the additions to supply catch up with absorption. However, there's still a cavern in terms of demand that we've had for space when we're adding to supply, and that obsolescence factor that I talked about a little bit. So I think the fundamentals for rent growth remain. And if I look at real estate, all of the real estate food groups, I think industrial and multifamily have a lot in common in terms of a relatively low availability rate and high demand for the space, which is what's going to drive up rents over time.
So you're expecting more rate growth, and on cap rates, you expect some more compression, or?
Yeah, no, I don't know, because 3 quarters ago I lied to your audience when I said that they wouldn't continue to compress. The thing that's interesting about cap rate compression is if we see interest rates going up, which let's assume we will see interest rates going up. If there'll be a gap between interest rates and cap rates. And I think given how hot industrial is relative to sort of the rest of the real estate investment world, I think we'll see a little bit of cap rate compression, 5 basis points, 10 basis points, where you might not see it in office. So if interest rates go up and office cap rates hold steady or tick up a bit, I could actually see industrial staying low. And again, it's all about the supply and demand and the supply chain and the linkage to the retail sector.
All right. Well, you heard it here on the show. We're real short on the break, but in 30 seconds, Mitch, where are the opportunities?
I think the opportunities are in the suburbs around urban areas, because the demand for space is going to be around order fulfillment. And I think the opportunities are along major transportation hubs and transportation corridors. So your interstates north and south, your interstates east and west, and don't rule out rail lines. And the last thing I'll say is we'll see what happens with the big coastal cities with the Panama Canal. Although I don't think that's a 2014 story. I think it's more of a 2015 story.
Well, Mitch, thanks for joining us today. We appreciate it.
And I'm, again, thrilled to be your first Skyped-in ever guest, Michael.
Thank you. And if you like more from Mitch and PwC, visit PwC.com. We'll have more on the industrial market in just a moment. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Atlanta Office Liquidators, new and used furniture liquidators, France Media, publications and conferences, and Bull Realty Commercial Brokerage, a great place to do business. For more information on these companies or to access additional podcasts, videos, or blogs, visit commercialrealestateshow.com.